Welcome, everybody. Thank you for coming to our webinar. A bunch of us are in different places and have things that are distracting us. I'll tell you, for me, I'm at the MTAC meeting. MTAC stands for Mailers Technical Advisory Council, and I'm at the USPS headquarters in Washington, D.C. And of course, I am Brad Kugler. I am the co-founder and CEO of Direct Mail 2.0. Also recently installed myself after the acquisition of Who's Mailing What as the CEO of that. So we like to deliver monthly webinars that will actually either educate you or enhance you in some way. And we like to talk about relevant topics. And this month, with changes in the commercial print industry and changes in the political atmosphere and changes in the economy and interest rates, I get questions, and I have recently since this acquisition, is how did you do this? And how did you know it was a good idea? And I thought, if I'm getting a couple of questions from our customer base, I bet there's a lot more out there. So what I've tried to do is gather some people who have had experience in mergers, acquisitions, buyouts, or sellouts within the commercial print industry. And these guys here all have had experience recently or over a long period of time. Some of us have very little experience. I would say me, but it may be pretty recent. And some guys do this for their living, Peter. So I'm going to turn it over to these guys to introduce themselves, and they don't have to talk about their experience in M&A, but just so you get an idea and a background of what they do. And we'll start with Eric up there. Eric, why don't you take a minute or two and tell us what you're all about?
Sure, will do. Appreciate it. Eric Vessels, most of you may know me as my 23 years of leading What They Think. Did that for a couple of decades. And just recently, earlier this year, have taken on a role at Taktiful. So I'm after a couple of decades and going through selling the business of What They Think in, what was it, I guess 2022 to the Association for Printing Technologies, and back at the startup game again. So I am the Chief Experience Officer at Taktiful. We are digital embellishment experts. We do training, and we have some software tools to make digital embellishment easier and to democratize that. So my experience mostly as an observer and somebody who has run a media outlet in the industry for many years. So I've definitely seen all the press releases come across, and I've talked to lots of different printers at lots of different times over the many years who have been through this type of thing. So hopefully I can add something of value.
Eric, what is Taktiful? Just in a 20-second little blurb, so we all are familiar with
So
it.
Taktiful are digital embellishment experts, nerds, sort of. We started off doing consulting on digital embellishment, both toner and inkjet, fifth and sixth color, as well as like your Scodexes, Duplos, and MGI jet varnish, those types of technologies. And out of that consulting came some realization of some real gaps in the market. So we started to get into the software business. So it's Taktiful Software Solutions is the name of the company. And I'm leading the training aspect of that right now. But we've got some really cool, if you haven't seen them, definitely get in touch. We demoed them at Drupa and Printing United, 3 different software solutions that allows printers to price, demo, and create digital embellishment.
And tactful meaning feel and touch. These are embossing,
Yeah.
just foils, things like that.
Yeah, exactly.
Okay, fair enough. There's some guys here that may not be familiar with that, so I wanted to clear it up.
Appreciate
Kasey,
it.
let's go to you. Tell us about what you got going on and how it relates to any M&A, or if you want.
Sure. Well, Brad, thanks for the invitation. I am here in Sacramento, California, Northern California. I've been in printing my whole life. I think Peter may have heard this, but I started as a janitor when I was 18. So that's many decades wasted in print here in Northern California. And then we done every job within the print space. And eventually became an owner and partner. And over the last now 15 years, I've acquired companies in our region and brought them together, and went from the first. I started on April Fool's Day 2008. Bought into a small open web printing company, and now with about 15, 16 employees, and now we have about a little over a couple hundred employees, a couple big good sized facilities here in Sacramento in the Northern California area, and we continue to look for opportunities to expand. So over that period, I've acquired companies of various sizes in the region and done every type of deal from sweat equity buyout on the first deal, SBA loans, done with partners, brought partners in for financing. Sorry. So we've done every type of, sorry, we're listening to Peter's background there. We've done a lot of deals and gotten to a size where we're about 50 or 60 million this year. Right now we are heavily into the political and election print space, pushing democracy forward here in the California region. And I've been pretty fortunate to have really good people that supported me along the way, and folks that work with me. I've got a great team, and I'm still in this for quite a while, looking for opportunities and see what's possible. But it's been a pretty, I think some of my competitors might think I have this big whiteboard with lots of opportunity, lots of targets, but we are much closer to looking for opportunities as they come up, and probably my best tool has been some adaptability and working out deals to figure out what works for a seller, what works for us, and how we can make it work. So we do a lot of direct mail. We do a lot of traditional print, digital print, large format. We are widely exhausted. We do an exhaustive amount of things.
Kasey, thank you. Your title and the name of your company?
Delta Print Group.
Okay.
And I'm the owner. There's a number, about 10 different companies, but it's all under the Delta Print Group branded umbrella. Just down into the weeds. Each company is actually separate, but under Delta Print Group is the name we operate under.
Wow, thank you for that. So just anyone in the audience, if you have a question, you feel free to use the chat or raise your hand, and I'll insert them as a moderator when I can. But last but not least, Peter, tell us what you do.
Well, besides sitting in an airport, and I apologize for the background noise. When we started, Eric accused me of having a virtual background showing the airport. So clearly, as you know now, I don't. So I hope the background noise won't be too loud. I am a partner at New Direction Partners. And on the one hand, we are like a conventional investment banking or M&A boutique where we primarily represent sellers. We do also represent buyers from time to time, but by and large, we more often represent sellers, where we are unique, and some would say really smart to do this, or some would say how boring could we be, but we work exclusively in the printing and packaging industry. And I've been doing that since the 90s at our predecessor company, which was Compass Capital Partners. I have 3 other partners that founded New Direction Partners with me. One is Paul Riley, who was one of the 2 founding partners at Symbeo, and I sold Paul 20-some companies back in the day. And another is a former client, Jim Russell, where he and I sold his 2 family print businesses in Michigan. And the 4th partner, Tom Williams, owned 2 finance companies to the print industry, both of which he sold to GE Capital. So we feel that each of us has a different background that works well with our specialty. And between the 4 of us, we've done 300 or 400 transactions within print, all segments, to virtually all buyers, with the exception of Kasey Cotulla. We have not yet sold a company to, so maybe everybody can put pressure on him to buy one of New Direction Partners' clients.
They always be selling. It's one of the things I preach.
Well, that's right.
You can do it here on a webinar in front of 100 and some people, then do it. I can't play. I would do it myself, All right. Well, thank you for the introduction. So I have some questions, and I'm going to pose the first one to Kasey. I'm sorry, not Kasey, to Peter, but I would like to hear Kasey and Eric comment on this if they have something that Peter hasn't done. What are the most common reasons that people would sell their commercial print business or any business in that fact? What have you found as driving maybe the top 3 or 4 reasons? And I want to see if Kasey and Eric have comments on that.
So you want to start with me, and
Yes.
I will say, Brad, people can decide to sell their business for any reason. And, we've seen a lot of reasons. For example, back in the Great Recession, believe it or not, a lot of owners just said, I love the industry, but I don't want to own a company anymore. I don't want to worry about making payroll and things like that. So it really does run the gamut as to why people decide to sell. But I would say the primary reason would be stage of life. If you look at I'm going to forget the exact statistic, but if you look at the average age of the owner of a printing company, I think the percentage is that 80% are over 65, might even be 68. So the main reason why people want to sell is stage of life. Another reason, though, could be, and it could be different than stage of life. It could just be that for whatever reason, the owner feels he's holding back his company, he or she. Maybe they're in need of major investment in the business and they don't want to double down and buy that new press or that new piece of equipment. And they feel they're holding back the business, so the best thing to do is to sell it. I had 2 clients not long ago who owned an incredible flexible packaging business, decided they had to sell. They were 28 years old. So it wasn't stage of life, but they realized that they had grown the business to its full potential under their ownership and they needed mentorship. So they went out and found mentorship. One more reason, and then I'll stop talking. And this is becoming more and more predominant. Our industry today, more than it's ever been, is one of haves and have-nots, where the haves have invested in the technology and made their companies communication companies as opposed to just printers. The have-nots have been reluctant to make those investments. For literally years, it was okay. They coexisted. Both companies could do well in the market. But today, without question, the haves are thriving. The have-nots are merely surviving. And they are feeling vulnerable and wanting to sell to a have. Sorry for the long-winded answer, but
I'm going to come back to that, but I want to get Kasey and Eric to just input if there's a reason that they've seen or come across in terms of people wanting to sell. Go ahead, Kasey first, and then we'll
Sure. Well, Peter hit on it. Stage of life, or they oftentimes a printing company is owner founder or second generation, and they have reached a point where they want to take chips off the table, or they're ready. And as Peter noted, reaching a point where what it takes to either keep going or to grow the business is putting capital in, putting reinvestment, putting energy reinvestment into it. So there certainly comes a point where, do I want to take on a debt load to add equipment to keep up with our capabilities in the marketplace, which is going to cost, turn that into years. That's a year's commitment to offset whatever equipment might be involved. That's going to take longer leases, longer investment returns. So oftentimes see that they are ready to not want to do that and ready to pass on. They may not have family members or a structure within their company that allows them to have a natural transition into who's going to take it over. Most of the businesses that I bought, approaching 10 businesses now, 10 print and mail businesses, are family founded. And so it's that owner's decision or recognition that maybe my kids, even if they're working in the business, and that's certainly been the case on some of our are acquisitions that family members continue working in the business, but that seller wasn't really going to put that burden on their kids, perhaps, or didn't see that they were going to be the best fit. It's going to be the most fulfilling to pass that on to them, and someone else comes in, myself, able to do a deal that makes them have the exit that they want and need, and still in a lot of cases preserve the company. That who can they find to keep the company going successfully, take care of longtime employees, take care of longtime customer relationships, and as Peter noted, things happen where it might be financial stress, loss of a big client. It might be I've seen it twice of lawsuits exhaust the owner, whether that's from a lawsuit from a supplier, a lawsuit from a employee. I'm in California, not always the best place to. So all those non-California printing sellers out there, they can contact me and we can figure out if we can do it here, we can do it anywhere. But there are sometimes there are occasions. It could be health, it could be divorce, it could be life-changing things that suddenly change the course. And so when you ask what reasons are there to sell a printing company, there's a lot of reasons. And my thoughts are always be prepared for the unknown. And it's certainly an industry that's changed a lot and continues to change. So what's been working isn't always what's going to work, and you've got to be prepared and have some conversations ready for making a change.
Thank you. That's insightful. I'm going to make a comment before I ask Eric. Both of you touched on a point of the owner sort of knowing his limits, whether it's burnout or it's risk adverseness to further investment, or even something that I've noticed. I've been doing business for 30 some years. There are people that can grow a business to 9 figures. There are people that can really grow a business to the 7 figures. And there's nothing wrong with the guy who cannot grow the business, but people have certain ability or skills or things that they can manage. And I think one of the best things about people is when they realize they've hit that limit, for whatever reason, they don't want to expand or grow beyond that, and they recognize it as a time to step down. All right. I have seen people try to go past their comfort level in growth and fall on their face. So being able to recognize it is not a failure. And I've consulted friends, can actually be a good thing to be able to recognize that. So I just wanted to point that out. Now, Eric, have you seen people that come up with other reasons for a sell that have not been mentioned here?
Yeah, for sure. But you make a really good point about self-awareness, though. I think that's a really critical skill as a business owner or someone at a high level in business, is to have that self-awareness of your own limitations. It's critical in building a business, right? Because you need to be able to find people that can supplement those perceived weaknesses, so long as you have the self-awareness. Yeah, Peter and Kasey really mentioned a lot that I had in mind. The only other one that might stick out to be different, as we know, the printing industry of itself has been consolidating for some time. And a lot of times I've heard owners want to sell to invest in another business, a different business opportunity, right? To sort of go move into some other business idea that they have that may be even non-print related. Definitely seen that happen. I've seen commercial printer go to almost solely packaging printer, or other growth areas. So taking that revenue from a sale and investing into a new business is something that a lot of entrepreneurs do, because they're never going to get rid of that itch. But Peter, I think probably the one that I've heard the most as well, stage of life. My first thought was like retirement. Or it's time for me to go. Another dynamic that you've seen in the printing industry and in family-run businesses is not all the kids want to do printing. Right. So it's like, it can't continue to be this lifestyle business. So the thing that makes most sense in terms of realizing that equity is to go ahead and sell.
Thank you. Great. Great.
This is a sorry statement sometimes, Eric, though. It's not even the kids who don't want to go into the business. It's the owner the parent, the founder, who will say, I don't want my children
Don't want them
to
to
go
have
into
it.
the business. And it's
Or
sad.
yeah.
But
Yeah.
you do hear that. Less today, I am hearing that. But through the difficult times, you do hear that.
Yeah. Well, and if you think about it, for them, that's a very informed decision, though, right? Like,
No question.
yeah.
No question.
Interesting. Very interesting. So the next one I kind of have here is most people will agree that sort of timing is everything to get the best possible exit. Timing can be a variable that has a lot of different facets, time of life, interest rates, the M&A market activity, is it a buyer's market, is it a seller's market? What comments would you guys have on timing? And let's make it simple. Is now a good time? If so, why or why not? And I'm probably going to hear you guys say, well, it depends on the business that's up for sale, and what's going on there. But let's kind of focus this next couple minutes around timing and how it relates to now versus a year ago or a year from now.
Well, I think for me, just popcorning, like one of the first things that comes to mind is personal readiness. Like I think there's a psychological component to, am I ready to, like, at least in my case, am I ready to give up my baby? And there's a ton of variables that go into that, right? Price, market conditions, right? Those inform whether I'm ready. Like I get ready real quick if the check is real big, right? But I think there is a mindset shift that sort of has to happen, and you have to sit down and have a long conversation. Sometimes it involves family as well. So I think personal readiness is one that came up for me.
Eric, Eric's got a great point there on that. Is a seller think, well, I'm ready to get a big payday, but oftentimes it is a willingness to recognize, I'm going to actually sell my business. This has been part of my identity. It's part of where I obviously go to every day. I've been responsible. And then sometimes their name is on the building. And that is going to be a change that can be slow to write. They like the idea of selling, but haven't pictured it enough to say, I'm ready to sell. I had a long time deal that had percolated, had been kind of an open offer for a number of years. And then suddenly they started down a path to sell or partner with someone that fell apart. And then suddenly they were at the table because I felt they reached over the tipping point to say, I am ready. I can see myself not owning this printing company and the legacy. If it's a family business, if it's someone they've been connected with for a long time, whether they founded it or took it over, that step is a big step. And then you go into the details of how is this going to work? How are my customers, employees going to be affected? What's my tax payout? How much will I make? How much won't I make? That readiness is a big part from a timing standpoint. But like the stock market, if you try and time the market, you're going to miss some upswings and you might get stuck on some downswings. And sometimes you try to time it, and interest rates 2 years ago, money was cheaper, deals easier to get, sudden changes, and what might have made sense from a return target is 2 years later different because there's not as much leverage available, and the buyers are going to be different than they were 2 years ago when interest rates are higher. So timing is not it's like timing the market. You can sometimes get lucky, and I love being lucky, but sometimes you just miss it. And it is a lot of psychology and a readiness to be a seller.
And you're never going to be fully informed there either, right?
Yeah.
Like, there's no way to talk to your future self.
Yeah. No, if we had a crystal ball.
Yeah.
I would just echo what both Eric and Kasey said, and that is the stars can be aligned perfectly that now's the time to sell. But I tell every prospect or every client, you need to take that emotional walk on the beach and say, is it the right time for me to sell? Forget about interest rates. Forget about the buyers. Am I ready to do this? So that's the first step. Going to your kind of second part of your question, Brad, going past the emotional aspect, is it a good time to be a seller today? it's a very good time to be a seller today. It is interesting, but there are more buyers in our industry today. Not many people would think this. More buyers out there than there ever have been. And that is because starting in 2014, after the Great Recession, our industry was blacklisted with the financial buyers. But since then, they've embraced us and they have entered into the attractive segments of the industry. And there are a lot of financial owners within the industry. And interest rates are high, yes, higher than they were, but they're being managed. They're under control. Banks are still lending. The economy's still healthy today. I don't know about next year, but right now it is a good time to be a seller.
Good. That's the good information. So we're a little about the halfway point, and I'm getting some good questions in, but I did want to ask one more that I think would be beneficial to most people before we take some audience questions. Misconceptions on the sales side. Obviously, you have a buyer who's down here and a seller who's up here, and that's a fact of life of almost anything, except when you go to the grocery store, you know what you're going to pay. When you're buying and selling a company, this chasm can be very wide and create a lot of emotional responses. What, other than sales expectations, because we all know those are probably the biggest misconception. Everybody overvalues what they think they're selling 99 times out of 100. What would you say are the other misconceptions that people might not think about? Let's start with Peter on this, because he probably dealt with it the most.
I think, and this is maybe going to sound surprising coming from my background, because one of the major aspects of my job is to maximize the proceeds. And we do, of course, take that seriously. But also, it's just enabling for the deal to get done, because transactions are hard. I think lots of times prospective sellers go into this thinking it's going to be a 2-month deal and it's going to be closed. And it's not. It is a distracting. Our average projects are 6 to 9 months. Some are longer. I've had some that have been multiple years.
And this
Some
is
are
the
shorter.
closing process, or this is just finding
Well, this
the
is the
buyer?
process of writing a book on the business, coming up with a list of buyers, contacting them, and going through the whole prospect. But that's not even really what I was going to answer, Brad. The most important thing is make sure it's a cultural fit, whoever you want to partner with. Because I don't care if you're the buyer or the seller, my advice is the same to either. If culturally it's not a fit, don't do the deal, because talk about unhappiness post-closing, you'll be miserable if culturally it's not a fit. So I do think that that's critical.
Thank you.
Yeah.
All right.
On that point there, Peter's obviously dealt with hundreds and hundreds of thousands of sellers, while I'm in the dozens. But one of the hallmarks is who is the buyer? Who would, part of the process is to picture who would be acquiring my company. If it's a local, in my case, local competitors that we are a complement to, or someone I can trust to run the business, those become some of the cultural fit that Peter was talking about. And understanding who might be buying your company is a really important part. If it's a private equity environment where someone's going to buy your book of business and tuck in all your equipment, and whoever moves to a different location, an important part for the seller is to understand who is the prospective buyer, and who am I willing to sell to, and who am I interested in selling to. And that might be, I give up some of my money to have a place for my employees to continue. There's a lot of different considerations in that, and it takes different shapes in every deal.
Yeah, the amount of time that the entire process takes was what I was going to mention. So I'm glad Peter mentioned that, because that's a mistake that I personally made. Just as an entrepreneur, you tend to move fast. Like we're just fast thinking, fast moving. Like, websites up this over the weekend, like we're launching that type thing. Selling a business is a process. It's a long-term engagement. There's lots of meetings and agreements and confidentiality and back and forth. So I think and I've heard this a lot from people that have sold their businesses, just that process, takes time. And I think culture is a great one, right? Because that's that walk on the beach that you have, right? Because no matter what, you have a legacy. If you've built a business and you sell it and you don't own it anymore, you still care about it, right? It's true for me and probably will be forever. So whether or not that legacy is going to be taken care of by the buyer is something that's important. And I think, should be thought through. And I think that's something that I think isn't thought through enough by a lot of sellers, because you hear on the back end of like, oh, I should have thought of this, or I should have thought of that, or whatever the case may be. So the process, it's long, but it, can be worth it.
I wanted to add something on the process. There's an emotional resiliency that a seller's got to have, because the buyers come in and through the diligence period, their job is to find things wrong with the company they're acquiring. Okay. And it can feel like a personal insult. Wait a minute. I thought you thought I had a great business here. Now you're telling me this ratio isn't good and this margin isn't right. And like you become almost insulted at certain times of the process. And I think that if I was going to manage someone through this, I would get them to expect to be torn down a little bit in your baby. You are going to be told what you have not done perfect over the years. When I'm not saying everybody thinks that they've got the perfect business, but they're going to find things that you didn't even know weren't perfect. And I have to say that when I went through that, even though I sensed it was coming, but when I was told about it by some fancy bean counter in Silicon Valley who has his Stanford MBA, who's half my age and shows me these models and numbers, and I'm like, part of you goes, do I even want to listen to this kid? But the guy that's going to write the check is listening to that kid, so I got to listen to that kid. So I wanted to just convey that personal bit of experience, and I'm sure that other people have experienced the same thing.
That's very, very profound. And you're spot on, Brad.
It's negotiation 101, though. You have to keep in mind, like you're negotiating, right? Like, so
if you break
in selling
during that process, the whole deal goes away, and
for sure. But if you're not prepared to walk away from a deal, you're not going to get the best deal.
Of course, that too. So it is an art for sure. And it takes an emotional maturity as well as business acumen to get through the process. It's not just like waving aside my business for sale and a month later you walk away with a big fat check. That's not really how it goes. And if it does, it's the outlier event. It's not the usual event. I'm sure you guys would agree on that.
100%.
I keep waiting for that transaction, Brad.
You hear about it like, when Facebook bought Instagram for $1 billion after they've been around for less than a year. Okay. I guarantee you there were parts even that deal, because you just hear the outcome,
Yeah.
Or some spicy moments even in that deal, So
all kidding aside, for me, it is so rewarding when we finish a deal and both the buyer and seller still really like each other. And I know that sounds like really low low threshold to strive for, but more often than not, exactly what you said, it's a very stressful period, and lots of times, particularly with the consolidators of yesterday, back in the 90s when there were all those consolidators out there, more often than not, by the time you got to closing, the seller despised the buyer. And it's so frustrating. And that does happen less today, but it does still happen.
I am sure. I'm sure. All right. Let's delve into something, I'm getting a lot of questions about multiples and packaging of deals. And I know that they can be from one end of the universe to the other. And people are asking, is there a multiple range for a commercial printer? And what is it based on? And usually, how are they packaged? Again, nobody's being held their foot to their fire, but what do these deals look like in general?
Kasey, it's 15 times EBITDA, right? Come on.
Wish.
It's funny why we've never done a deal together, Peter. Jeez, I don't know.
I mean, you
it,
knew this
it,
question was going to come. I mean, I've already got 4 people asking about this stuff,
I, it's for my analysis. So we usually self-fund. Fortunate now, don't have any bank debt. We're not a private equity. We're trying to build a business that is durable. It's going to be around doing different things. Well, even beyond me being here, I've got great teams under me, and we look for what's going to be a fit into it. And certainly is looking, okay, what is there any debt with the company? What's the equipment space? What's the depth and breadth of clients, and what's the free cash flow? And then we're going to value from there. And the multiple will be based on what we can grow it. Obviously, it's going to be 3 to 5 multiple of its free cash flow and what we can make it work. And then work on a deal with the seller. What does the seller need? What does the seller want? What are their priorities? When we're doing deals, that's what I'm looking at. And it depends. That it could be a great company and it's got a higher multiple. It could be a great company, but it's going to take a lot of energy and distract. For my effort, does this distract from my core business right now to try and integrate this into us? And also a key part for me is always, how do I add value? How does my organization add value to that enterprise and make it continue doing what it's doing well? And then also look for how it's going to grow. And that could be with capital, that could be with technology, that could be with obviously great leadership as part of it. But the reality is, how are we going to add value and make that a better company so that it can pay for itself? That's really what I'm always looking at.
Now, short of that, let's say there's situations where, I don't want to say distressed, but there really is no cash flow when you pick apart the financials. Is there a path to a deal in a company like that? Is it just the assets? Is it via some sort of managed liquidation or bankruptcy? How do those deals get done?
Well, for me, if we're buying a company, I'm sorry, I'm going to hear that if I'm seeing a company that maybe isn't going to be, they've reached their exhausting point and they're not going to grow without further investment, is really approaching it to how can we work out something that is going to pay that seller over time. Might be a carryback, might be a performance based, keep things. That's one of the best parts for me, is that I have a lot of flexibility to try and do a deal built around that seller. And that's different than a private equity funded group or someplace that's just looking to grow their top line and sell the whole package off to somebody else. Mine is more of a durable business approach. And that's what the pieces I'm looking to add to our mix is, what's a company that complements what we do.
But Brad, can I take a stab at answering that?
Yeah.
Because it's interesting. I think Kasey and I actually have very similar answers, but I think when you're looking from a seller's perspective, you maybe get there a little differently. So to go to your question about the tuck-in or the companies that are losing or not positive net cash flow, whenever you value a business, whether it's printing or any industry, you need to look at it 2 ways. What are the value of the net assets? And that's the working capital, the fixed assets, the equipment, and a goodwill factor for the customer base. So it's kind of a tuck-in transaction in our industry. That's the net asset value. And then what's the earnings-based value? And whichever is higher is the way you're going to sell. So that's how you determine if it's an EBITDA multiple or an asset valuation. In terms of the EBITDA multiple, it's interesting. Kasey threw out 3 to 5. And I'll tell you what I was going to say. I was going to say on average, it's 4 to 5. But there are buyers for certain companies and certain companies in the mature segments and that are not growing, that are going as low as 3 times. So actually, really, we kind of have the same range. I would say in determining the multiple, there are a whole bunch, and this is a whole webinar in itself, but a whole bunch of quantitative and qualitative factors you need to look at. But the primary thing that drives a multiple, again, in any industry, is growth. Growth drives multiples. And it's not growth through acquisition. Unfortunately, it's organic growth. So if you have that, you're going to get a higher multiple. If you have critical mass, you're going to get a higher multiple. If you're in one of the great niches like one-to-one direct mail or POP or large format within print, those are very attractive segments because they're out of the price commodity business. They're going to get a premium multiple. So we have sold some companies since COVID for 6 or even north of that. But to be really clear, that's very unusual and does not happen often. 3 to 5 times is the average. And then you look to see if there are extenuating circumstances.
Would one of those extenuating circumstances, you mentioned the have and have nots, you're assuming a certain amount of current infrastructure and services versus a, 1980s machinery, and they're not doing anything technological. They're at the lower end, or where does the have and have nots sort of push that multiple?
So I'll just say this, and I'm telling you, people don't think I'm serious when I say this, but back in the day, and this would have been pre-Great Recession, if you had 2 identical printing companies that had the same EBITDA, but one had a 1980s vintage press and the other had a brand new press, they'd sell for the same price. They'd sell for a multiple of that EBITDA and it would be the same price. That absolutely does not happen today. So, and clients are surprised when I say this, but when they ask me, should I be investing in my business when I'm going through my process? My answer is always, of course you should. First of all, you have to run the company as if a deal is not going to happen until the day it closes. But secondly, if you're holding off on investments that really need to be made, and I'm not saying optional, this is going to make us stronger for down the road. But if you need to make investments, if you don't, it's going to be reflected in your valuation. So you might as well make it. Again, I'm not saying to go crazy, but you have to invest in your business. And if you want to get the premium multiple that we're talking about, you have to figure out how to become a have.
Right. So if a guy's doing $5 million in commercial print and he's got to go spend $1.5 million on a new variable digital inkjet, is it worth it? I mean,
well, I would argue if $5 million commercial printer does not need, for their current book of business, they do not need to go buy that type of press. If they want to transform their business over the next several years, then yes, they probably would want to consider that type of investment. So that there is a distinction between making an investment just so you can make your company better over the next couple of years versus what do you need today to service your existing customer base.
Right.
Does that make sense?
And these aren't always capital expenses. They could be
That's right.
Service features or new things, services you add to your menu or your catalog, So it doesn't necessarily have to be full capital. Eric, I know that you have been chomping. Please.
Sorry, Eric.
I feel like I've
Eric.
ignored you.
I was actually just going to ask a question of the experts. I'm wondering, depending on how the numbers shake out, one or the other side of this equation is going to be more enamored with a multiple than the other, right? I feel like that, and I may be wrong, I'm not the M&A expert, but that feels like always sort of a starting point, and then all the other factors figure in after that, right? Because if the numbers shake out, lower than expected, then the buyer is going to be like, oh, it's lower multiple, and if it's the other way, that's a question, by the way, for you guys.
So are you saying the EBITDA multiple is lower than the asset value?
Well, what I'm saying is, like, depending on how the numbers shake out, it seems like the buyer or the seller will be more focused on on using a multiple, right? Like, because the numbers favor one side or the other. So I'm wondering about that dynamic and how you should treat that as a seller from
Kasey, disagree with me, but if you're going to look at the asset value and the earnings value, and the asset value is higher, lots of times people will have a very low EBITDA and they're going to say, well, my gosh, if you take 3 times this, you're not even up to the debt that I have to pay down. But if you look at the asset value, you have a surplus. I think buyers are willing to pay the asset value as long as they can develop a clear plan on their own to profitize the business, because they're not going to be happy if after they do that deal, it's still being valued off the asset valuation. So they need to get comfortable that they're going to be able to profitize it.
That makes sense.
All right,
I'm sorry, it just simply goes back to, how do you add value to this company? How will you help it grow? And that might be taking the assets that might be either not fully used or utilized and turning that into more profitable by your client mix that you might be bringing into it. Or, as Peter says, how much profit does it turn out, and work off of that number. So it depends. Honestly, the final deal often depends on how does the buy structure. You can get a higher multiple if you're willing to do some half carry back, or carry back a note, or for 4 to 8 years. Then that's putting some risk on the seller, but they get a higher price. If someone's coming in with cash, I'm going to expect that to be a much lower. That'll be a lower multiple, because they're getting the cash out, and that buyer is taking the full responsibility to have that business continue following its track record.
Sure. You want your 15 times earnings? Give me 150 years to pay you, done deal, So I get it. All right. I have a question that I don't think we've treaded on, that came from one of the audience members. It says, what about mergers? What kind of criteria are you looking for? Different skill sets, additions of new markets? How does culture play into the merger and acquisition decision? Whoever wants to jump on that one, go ahead.
Man, I mean, my first reaction is all of those things seem like something you would consider and would be beneficial. If you should be looking at diversifying markets, diversifying technologies. Like, you want it to be mutually beneficial, right? That's my first reaction to that question. And then obviously culture is hugely important, because I think we've seen that happen time and time again, right? And whether it's from printing companies or even the OEM, the vendor communities, when it happens, you see people not be happy because cultures weren't necessarily aligned. So I think all of those things are important.
Okay. Any other comments there?
Sorry. Go ahead.
Go ahead, Peter, please.
No, please. You go.
I would just say, from a culture standpoint, because we put companies together into the same buildings, and you must respect the culture of the enterprise that you're buying or potentially putting together, and how that might fit. So we've got, I like to say, we have largely Hispanic workforce at one company, hillbillies, if you will, at another. No offense to anybody, and some that are cultural. They're dealing with a lot of ad agencies, and so you bring those together. You've got to recognize that, and if you don't pay attention to it, then you will pay a price in losing talent, in losing clients, and that must be considered in how you're putting together, as well as the technologies fit. How are these companies going to communicate and share resources?
Agreed. Peter?
Cultural. Just like I said, growth. It's cultural. It has to be a great fit. And, the question, I think, was really geared towards mergers as opposed to an outright acquisition. And I wish we'd see more mergers in our industry, because I think it's really healthy. Because when you think about it, if you have all of a sudden you have two partners who are both owners in the business as opposed to just one, their motivations are aligned perfectly. But in order for that to work, culturally, it has to be a great fit, because we've all seen bad partnerships, and that can be disastrous. But we've also seen good partnerships, and good partnerships can be incredibly fruitful.
Yeah, I think especially in a consolidating industry too. I think mergers are a way to strengthen the industry overall.
Do mergers come in this industry? And again, I'm not familiar. Are they tend to be cashless at close? Is it equity swap and profit sharing of the combined? How does a merger work in this industry? Or I guess it would depend on the size of both companies, but do they tend to be cashless at close in most cases, or in some cases?
It depends. If they're similar sized and they're similar profit structure, a cashless merger is perfect, because that means you're going to have two equal partners. But again, that can be very
Okay.
with culture and if they don't get along. But you can do a merger where you're going to have one 90% owner and one 10% whole owner. That's still a merger. And it's not a merger of equals, but it's a merger. And so in that instance, cash would be trading hands most likely, but maybe not. They could just be taking stock in the new entity as well.
Interesting. Someone asked here, and I don't want to pretend to know the answer, so I'll put it to you guys. What is your formula for earnings value? Are we just talking about EBITDA here, or is there some other play on words? And I don't want to assume that I know everything. And sometimes we need to take this down to brass tacks for some people that are new to this type of language. And again,
I'll speak to my
formula?
own. I won't use formula because each situation is different. But how can I grow this company to pay for its acquisition costs? And I haven't done mergers. Everything has been an acquisition, and I've had partners in the mix. I've bought out partners, and now I'll own it all here come December 31st. So it's all my fault. But the reality is that part of how does this company that we're going to acquire going to be able to pay off the debt or the note or the price I put into it? And that's as simple as that. Now we can use a book value, a net asset value, but how will that pay? How does that going to turn out? If the relative to its debt, to its assets, how is it going to service whatever debt it does have? It's the debt that I'm going to carry or the cost that I'm carrying to acquire the business. How will it pay for it? For me, it's as straightforward as that. How is this company going to pay for itself? I look at it, to me, a multiple, I look at that seller is giving me, if they're using a 5 multiple, that means I've got 5 years to make this pay for itself. That to me is what a multiple is. And it's really simplistic, but it really is that I'm paying that person how many years it's going to take for me to pay off the acquisition price.
So are you just got a big fat juicy line of credit, and it's basically an asset-based loan based on what it generates and what it's got on its books? Is that how it works?
I'm sure Peter has different people. I use my own money. So we've not, we're using carryback, we're using our own capital, my own capital to do an acquisition. So that's why it's not a fit for every seller. But it is understanding, what does the seller need? Does the seller want some money to show that they're doing it? And ideally they're a check in the mail for the next, from a reliable, well-moneyed person and group to be able to make that deal pay off over time and get a better multiple because they're taking that payment over the next 6 years or 7 years.
Okay. I was just going to ask, what are the usual terms? I'm guessing it's 6, 7 years sounds like the sweet spot. Makes sense.
Mm-hmm. Brad, I would agree with Kasey 100% that any buyer is going to have a model where they're going to determine their payback, and they're going to determine, okay, based upon this should be if it's a financial buyer, they're going to look at their IRR and what type of return are they going to generate. Strategics don't always do that because they don't intend to sell, but they're going to look at how quickly can we get the debt paid off. But in terms of determining what the value should be, it is, and I'm not saying it's the best way to value a business, but every buyer tends to look at EBITDA, and it's not really a 3 or 5 year average EBITDA. It's the trailing 12 months. It's not the projected EBITDA, it's the trailing 12 months. Now, if you're making a projection for a year and you're going out to market in like June or September, and you have projections through the end of the year, and as you go through the process, you can show you're meeting those monthly projections, you might be able to sell off that one budget for the year, but it is trailing 12-month EBITDA that really, if you're looking at an earnings base, it deviated a little bit during COVID because that was such a just situation that we had never seen before, but that's in the rearview mirror, of course.
Great. Good answer. So I'm going to wrap it up with the last question here. I'll give you each, 30, 40, 50 seconds to answer, and then we'll kind of wrap up. Question is, what strategies would you recommend for someone with experience and the skill set for ownership, but lacking the immediate capital to pursue an acquisition? So I'm a guy, I might not have a lot of capital, but I want to acquire a company. How do I do this? Is it the old no money down, make a deal with long-term terms? How do they make a deal if they want to acquire, but they're not Daddy Warbucks? Is it even possible?
I've lived that. That's how I became a business owner, went from being a CGX company president, cobbled together some savings and did a sweat equity purchase plan. A key part is recognize you want to do it, take that risk, and then you've got to get everything in writing. So the worst things I see is when someone has gone to work for someone, yeah, that guy's going to sell the business to me, whether that's printing or whatever, and not have it in writing. So a key part, it is doable. It can take time, but it's also, you're able to do it with shallower pockets, but a good skill set and a good resume. So it can be done. And part of it is just approaching who you think might be interested in a deal, or at least starting conversations and spread the word that with that, because that can get repeated beyond that you are interested in buying a company, and then opportunities can crop up where you didn't seek them out.
So let me just carry on that to a little more of a concrete. You got a little commercial printer who's doing 3 to 5 million. He's making his 10% EBITDA. What kind of cash to close and terms to pay it off? Where would, I'm sure you can do the numbers in your head real quick. How much money does he have to have in his savings account to go do that deal? Approximately, close it.
Let's say the company is going to sell for $2 million because it's really profitable but small. That owner's going to leave. That person's going to take their place. So there's a lifestyle business, but you got to pay for that. You might have to come in with 10% down, but then a sweat equity agreement that eventually, if you can get to the 20 or 25% ownership part to your sweat equity, then you can leverage that into an SBA loan or some other finance operation. And that's what I did. That's how I got our first company, was with me and my partner. We got to the 20% level, and then we were able to buy out the founding partner and go from there.
Fantastic. Peter, you got something to contribute on that?
I would just say that I agree with what Kasey said. Obviously, Kasey did it, and he's been a great success. So it's a wonderful example. I would love to see it happen more often in the print industry. It doesn't happen that often. I have seen a number of owners hire a professional CEO with the intent of selling it to them down the road, and it just doesn't always seem to turn out. But when it does, it can be incredibly successful. It's great. The only other thing I think I could add is there are some, not a lot, but there are some financial private equity type firms that invest in managers like this and will help them buy the companies, and they'll get paid out over time. They're becoming more and more popular, and they're called some of them are called search funds, where they back just an individual like Eric. If Eric wants to go out and buy a company, they'll back him. And so it is happening more often than it used to. I wish it would happen more. I think it would be great for the industry.
Are you ready to back me, Peter?
Yeah.
I'm not that type of firm, but I wish I were.
No,
Eric,
I mean,
final words?
Yeah. Kasey's answer actually was spot on, and as he was giving it, I was just like, "Yeah, there's no follow to that." But I was going to mention basically what Peter mentioned was like, get backing, right? Like if you've got the skill set, if you've got it could be a lot of things: reputation, skill set, track record, whatever it is especially within a niche industry. Find people with money that are friends or potentially investors that look to back people like that. So. That's one way to do it. And I agree wholeheartedly with Peter. I wish we would see it more for sure, because I know there's a lot of talent out there.
Yeah. And you know what's interesting? When you really sit down and think about it, everybody says this is such a low margin industry, low margin, capital intensive. There have been some incredibly successful people in our industry, incredibly successful. And it's a great industry, and it offers great opportunities, and it's going through a great transition right now. So it's exciting.
Yeah. Higher margins with digital embellishments. Talk to us.
Yeah. Hey, listen,
Yeah.
you guys have been great. I really appreciate the transparency. It is, I've gotten a lot of comments that this was a fabulous webinar. It will be posted on the Direct Mail 2.0 website in a few days, and we will be sharing the copy of it with everybody, as well as contact information for our fabulous panelists. So please follow up with them. I'm sure they'd love to hear from you. Guys, thank you again. Great webinar. And talk to you next time. Bye-bye, guys.
Thanks for having me. Learned a lot.
Cheers. Thank you.
Thank you so much. Take care.